So we'll start with the joint products and byproducts in this class. C. Input introduced and it is jointly processed up to certain point in time. Thereafter, it may be splitted into 2 or 3 different outputs. Is that okay? So the input direct material and some direct labor overhead may be incurred. To convert that finished input into 3 or 4 different types of output, probably A, B, C and so on. We cannot identify that these costs are especially for production of A or B or C. Hence, we will call this being the joint cost. Now we have to segregate this cost for these 3 different products we produced after this point. Understand? Now, this point is called split off point. Split off point. These are the 3 products. If all the 3 products are having the equal value or weightage, then we will call that being the joint products. Or A has a predominant weightage and B and C will have lesser weightage, then this will be called as main product and these things are called byproduct. Some product will have very lesser value called as scrap item, or sometimes it may be negative value also possible, negative value for disposing. For example, if you take the rice from the paddy, you are converting that in a joint process into rice as well as rice ball. You understand? So this process of converting rice paddy into the rice is joint process happening this one up to this point, and conversion is only for the requirement of what? Rice, not for the burn. Now rice will have, say, the paddy per kg may be 20 rupees. Rice may be saleable in the market for rupees 50, but burn can be saleable only for 10 rupees. So the main product being the rice and burn is not the main product. So this will be called as byproduct. This is main product. Then how this 20 rupees is going to be allocated for these 2 products is going to be studied here. So we have a number of methods. C. Input, joint cost, material, labor, expenses. At this point, split up point, we get 3 products where the A and B are having the most valuable market worth. Then it will be called as joint products or main products. This X being having small value called as byproduct. After the product process, this can be saleable in the market directly, or it may go for further process and saleable later on. Okay. So can we do further process or not? Further process means again we additionally spend material, labor and other expenses to convert this output A into A1 like. Okay, that's called further process. So joint process, split off point, you can sell here itself. Some product may be processed further and you can sell here. Some product may be sold here itself. Okay, that may also be possible. This will be called as further process. How the joint costs are going to be allocated. So rather than summarizing the concept, I will try to finish up the illustrations. Then I will give a summary so that we'll be able to understand easily. Okay, come on, you can guess it very easily. Rama Corporation produces 4 products in the manufacturing process. The corporation produced 10,000 units of A and 10,000 units of A and 20,000 units of B, 15,000 units of C, 25,000 units of D. All these things are produced at a single split off point. You understand? The cost before the split off point, this point is called split off point, and cost before that being 1,40,000. Then this cost, converting the input into 4 different output, cost us this much, 1,40,000. This is called joint cost. Now the question is how this 1,40,000 can be allocated to these different products. Right. So the method you have to follow here being using average unit cost method. Come on, find out what is the total output we get. 70,000 rupees. Joint cost being 1,40,000 rupees, and total output of all the units being 70,000 rupees. Then allocated joint cost per unit being 2 rupees. Calculate the cost, unit cost. Unit cost is calculated. Show how the joint cost is going to be allocated. So joint cost. This is output. Joint cost 1,40,000 will be allocated based on this unit price. Per unit price is 2 means 10 into 2, 20,000 rupees, and here 40,000 rupees, here 30, and here 50. Is that clear? This is called average unit cost method. You can very easily understand that you no need to study this one at all. But a comprehensive illustration also asked in this topic in the examination. In advanced problem, I have solved this illustration. You can see that one. So you'll be able to understand how advanced level of questions can also be asked in this topic. Question number 2. Come on, try it yourself. It's very easy. Joint products. We get these are the products. How many products? 1, 2, 3, 4, 5. The following data is extracted from the books of Messrs. East India Coke Company Limited. In that split of point, they produced coke, coal tar, benzoyl, sulfur of ammonia gas. Then yield in pound, okay, 1,420 pounds. Pound is approximately 454 grams, okay, per ton, okay, per ton. The input being 110,000 kgs. Okay, for 1,000 kgs, we get this much of output. This will be 120, this is 22, this is 26, and this is 412. You'll get 2,000 pounds. 454 grams. Otherwise, roughly 900 grams. Otherwise, there may be some loss. 2,000 means automatically it is 950 grams, like kilograms, like you will get. Some wastage is there. This is the output anyhow. Least bother about the pound and other thing. The price of the coal is 80 per ton. So direct material being 80 per ton. Direct labor and overhead cost to split up point are 40 and 60. Okay, per ton of coal. Calculate the material, labor, overhead, and total cost of each product on the basis of weight. Okay, the total cost being 180. Now you have to calculate what is the direct material cost for every item, direct labor cost for every item, overhead for every item, and total cost being the summation of the three in total. So direct material cost up to the split of point being 80, this being 40, this being 60, and finally this is 180. Physical unit method. So 80 divided by 2000 into 1420, you can do the cross multiplication using the same ratio. In this ratio, you have to segregate all. 80 into 1420 divided by 2000. I think you will get 56.80. Then 4.80, 0.88, 1.04, 16.48. In case of direct labor, 28.40, 2.40, 0.44, 0.52, 8.42. Overheads 42.60, 3.60, 0.66, 0.78, and 12.36. You have to sum all these things to get the total cost. Or 180 into 1420 divided by 2000. This value being 127.80, 10.36, 80, 1.98, 2.34, 37.08. That's all. So requires no explanation. You can easily solve this illustration up to now. Shall I move on to the next one? This one, here we have to give the weightage, that's all. Weighted average method. Average price method we have already studied, average quantity, here weighted average quantity. Because the output what you produce here being first grade, second grade, third grade. Okay, the total being 1500, but all the three will be not equal because first grade will be saleable at a higher rate. So definitely higher cost can be allocated to that, right? Now we need to know the weightage. In the timber industry, the milling operations to the split up point during the period amounting to rupees 17,400 with the production. So milling. Here we get first grade, second grade, and third grade timbers. And the joint cost here being 17,400. Now you have to distribute 17,400 for these three types of material we produced. And units being 400, here 500, here 600. Overall 1,500. You are required to apportion the joint cost to technical evaluation on technical evaluation with the points 5, 4, 3 for first, second and third grade respectively. Now grade is given. Grade may be considered as weight. Like in goodwill calculation, you may calculate simple average profit and weighted average profit. Like so, here also you are going to take the weighted average units. So the weightage for this being 5 and here 4 and here 3. Now find out the weighted units. Weighted units here being 2000, right? 400 into 5 and 500 into 4, 2000 and 1800. The overall value being 5,800. Now, cost per weighted unit is equal to 17,400 divided by 5,800. What is the ultimate value? 3. So now you can split the joint cost 17,400 rupees using this way. Per weighted unit cost being 3 and you multiply with the weighted unit. So 2000 into 3, 6,000, 6,000 and 5,400. Hope will be now able to understand. This is called weighted average unit method. Next, this one is very rare, contribution margin method. So we have what? Variable cost as well as fixed cost. Variable cost is segregated using the units. Fixed cost is segregated using the contribution. That's what about the logic here. Very rare this one. Anyhow, we'll just understand this. Okay. Find out the cost of the joint product. Cost of joint product A and B using contribution margin method from the following data. So joint process, we get two products here, A and B, and units being 100 kgs of A, sale price being 60 rupees, and 120 kgs of B and sale price being 30 kgs, 30 per kgs. Joint cost. We have marginal cost. Marginal cost is equivalent to variable cost, and fixed cost 3,900. Now total sales value being, come on, what is the total sales value? 6,000, 3,600. Now we have two costs. How can I segregate the marginal cost? Marginal cost 4,400. This can be segregated using the units. This method, okay. 4,400 divided by 220, or you can distribute using this value. Come on, 6,003. Okay, come on, 100 and 120. So 5 by 6. This is nothing but 5 share, and this is 6 share. So 5 by 11. 5/11 is for A. 5/11 is for A. How much? 2,000, and 4,400 into 6/11 for B. 2,400. Now the fixed cost should be segregated using contribution. First you have to calculate the contribution here. What is the contribution? Sales minus marginal cost will be the contribution here. So 6,000 minus 2,000, 4,000. 3,600 minus 2,400, 1,200. And fixed cost. Fixed cost 3,900 should be allocated using contribution. This one is allocated using the units. This is allocated using the contribution. So 3,900 into, okay, this value being 5,200. Okay, so otherwise 40 by 52, and 3,900 into 12 by 52 for A and for B. You get 3,000 rupees here and 900 rupees here. So all these models are very rare only. I am going to discuss the important models hereafter. Okay, these are the models may be expected. Unit may be coming, others you can skip, and the last model I am supposed to discuss is all about sales price model. So those things are very often you can expect. Now, fifth one, market value or sales price method at separation point. The joint cost of making 40 units of product A, 120 units of product B, and 140 units of product C is 2,250. So we produced 3 units, A, B, C. The joint cost being 2,250. Right. How many units were produced here? 40 units, 120 units, 140 units. This is called split off point, otherwise named as separation point. Once the items are separated, immediately sold is called separation point sales price. Suppose we need to do some other additional expenses like further processing, then that will be called as sale price after further process. So sale price at split off point, sales price after further process. Here sales price at separation point is going to be considered. The selling price per unit being ABC 2, 3 and 4. The product did not require any further processing. Cost after split off point. So further processing means immediately after split off point it is going to be sold. There is no further process required. You are required to apportion the joint cost on sales price basis. Now what is the joint cost you have? 2,250. What is the sales price you have? 2, 3, 4. So this ratio you have to follow to segregate this joint costs. Allocated joint cost. allocated joint cost. 2,250 should be shared among the three products in the ratio of 2:3:4. Okay, 500, 750 and 1000. Now, what happens in case of sales value basis, sir? You have to find out the sales value first of all. Sales value is nothing but units into sales price per unit. 40 into 2, 80, 120 into 3, 360, 140 into 4, 560. Total sales value being, how much is that? 1000. Okay, 1000. Now, allocate the joint cost using this sales value basis, 2,250. You are allocating using this basis. Here, we allocated using the sales price. You can allocate the joint costs to the products, joint products, using the sales price of these items or sales value of these items at the splitter point. Now, 2,250 into 80 by 1000, 180, and 360 divided by 1000 into 2,250, 810, and finally 1,260. Clear? Now, sixth one, same market value after further process. What happens here? Find out the market value after further process. That is the base to distribute the costs. X company limited manufactures two joint products. A and B. Sells them at rupees 4 or 5 or 4 respectively. During a particular period, 400 units and 500 units of B were produced and sold. 500, 400 and 500. The joint cost incurred was 180. Further processing cost for product A and B are 1,600, 1,500. After the manufacture, further process cost is also there. That is called further cost. 1,600 and here 1,500. Apportion the joint costs. We assume this is nothing but what? Sale value after further process. After further process. Then the joint cost 180 can be apportioned using what? Sale price. Allocated joint cost. Allocated joint cost. 180. Similarly, the same 180 can be allocated using the sales value. So we need to know what is the sales value. Sales value is nothing but sales price into number of units. 2,000, 2,000. So total sales value 4,000. This joint cost 180 is going to be allocated. Allocated joint cost using this sales value ratio 90, 90. Now, question number 7, most interesting illustration. Most of the cases you can expect this model only. This model only. Either sales unit or directly question number 7 model. A factory produces 3 products A, B and C of equal value from the same manufacturing process. The joint cost before split of fine. Joint cost 19,600. Subsequent costs are given is as under. Okay. Show how you would propose to apportion the joint cost of manufacturer under net realizable value. NRV model. So let me try to solve this illustration under the NRV model first of all. Then I will proceed with the constant GPR model. Okay. What is called NRV? Sale value minus expenses to do it, means to sell, like further process cost. Sale value minus further process cost. That you may usually study in most of the cases. What is the NRV? Sale value minus any commission payable on sale will be subtracted. Similarly, sale value minus any further process cost is spent. So we have 3 products manufactured. A, B, C, and the joint cost being 19,600. 19,600. Direct material, direct labor, overhead. This is further process cost. These are further process cost. After this, to process it further, before sale, 2,500 rupees spent for processing further of A, B 2000, C 1500. And here selling price being overall sales. Overall sales here being 30,000 and 20,000 rupees. And expected GPR in this case being 30%, 25%, 20%. This is the GPR. Okay. Now, find out the GP. What is the GP here? 30,000 into 30%, 9,000. 24,000 into 25%, 6,000 and 4,000. Is that okay? Sales and GP. This is further process cost. I have to calculate the NRV here. NRV in this case is equal to not only further process cost. If the GP is given, that should also be subtracted. GP should also be subtracted. So I will put the NRV here. So NRV is equal to, okay, sales, final sales value minus GP minus further process cost. That's what about the NRV. I put that value here. So NRV is equal to sales value minus GP minus further process cost. Come on. First case 18,500. 30 minus 9 minus 2,500, 18,500. 16,000 next. 14,500. Now, what is the total of NRV? 49,000. This joint cost 19,600 should be distributed using this ratio. Allocated joint cost 19,600 into 18,500 divided by, or 185 divided by 490. Is that okay? Using this ratio, 18,500 divided by 49,000 or 185 divided by 490. 7,400 6,400, 5,800. This is NRV method. NRV method. Now, the total further process cost of all the three being 6,000. Now, this is the NRV model, very important model. The next one is all about constant GPR model or reverse calculation model. These two are called reverse calculation model only, but here the GPR given. Sometimes GPR is not will not be given, so you have to calculate. In that case, you have to calculate the GPR as per the normal provisions. Sales minus cost is the GPR. That is the GPR percentage applicable for all the three. What's the total sales? 74,000. Now I'm going to follow the constant GPR method. This is NRV method. Now I'm going to follow constant GPR method. Constant GPR method. Constant GPR method. Sales. How much is the sales total? 74,000 minus joint cost 19,600. Further process cost in total 6,000. Then what about the GP? GP. What is the GP? Huh? 48,400. Find out the GPR. GP by sales. So here GP being 48,400 and sales being 74,000. 65.41%. Is that okay? So earlier we have different GP, but here we calculated the GPR being called. Come on, get me the GP using this GPR method. For 30,000, 65.31%, 19,622, and 24,000 into 65.41, 15,697, and 20,000 into 65.41, 13,081. The total GP being 48,400, isn't it? Only this will come. Now, allocated joint cost. Allocated joint cost. This allocated joint cost under constant GP NRV model, constant GP based NRV model is nothing but NRV only. Sales minus GP minus further process cost. That is called allocated joint cost. You don't need to further allocate. If you have the joint, means GPR, constant GPR, using that constant GPR, find out the GP, subtract that also, and further process cost also from the sales. The balance value will be default allocated joint cost. 30 minus 2,500 minus 19,622. This value being 7878. 16,000 minus 2,000 minus 6,400. 6303. The last one 13,081. Sorry, 20,000 minus 13,081 minus 1,500. 5,419. The value being 19,600. Default allocated, you don't allocate further. If you follow the constant GP that you calculated this way, sales minus total joint cost minus total further process cost, you get the total GP. Then average GPR for all the three products is identified. Using that, if you calculate NRV, that NRV itself allocated joint cost. NRV itself allocated the joint cost. C. Now, joint product and byproduct, apportionment of joint costs. Joint costs can be apportioned using the average unit cost, physical unit cost, survey or weighted average method, contribution margin method. So these are the method we have studied. And we need to have the market value method also. Under market value method, at the point of separation, using the market value or market price, you can segregate. After further processing, use the market value or market price, you can calculate the or allocate the joint costs. All we have seen all the illustration. The predominant method you have to understand is nothing but the reverse cost method or NRV method, the last method we have seen. And reverse cost method or NRV method, there is a slight variation which is considered, which is nothing but constant GPR method. Okay, under constant GPR method, find out the constant GPR by subtracting the total joint cost and total further process cost for all the products put together from the total revenue of all the three products, and from that GPR is calculated. In that case, from the sale value, GP as well as the further process cost, if you subtract, you know, the whatever the balance you get, that balance itself allocated joint cost, you no need to allocate further. So most probably in your examination, these two types of questions very often may be asked. Even this one also. Is that clear? Hope now you'll be able to understand the apportionment of joint costs. Apportionment of joint costs. If it is clear, text me. We'll move on to the next concept. Allocation of the costs to the main product as well as byproduct. In case of byproduct, how can we handle it? Now, main products with byproduct. So here we have main product as well as byproduct. Then how can we allocate? Allocate the joint cost under NRV method. Under NRV method. So joint cost being 1 lakh. Joint cost being 1 lakh. How can we allocate this? Okay. Now we have to follow NRV method. As per the NRV method, sales value minus further process cost. If the GPR is given, you can subtract the GPR. Yes, this is the NRV. Using this NRV, you have to divide this joint costs to the product. Is that okay? Now, three products we have, A, B and C. Joint cost being 1 lakh. Output being 1000, 500, 1000. Sale price being 100, 150, 10. Scenario 1. In scenario 2, assume this being 0. We'll solve that later on. And what about the sales value? 1 lakh. 500 into 150. 75,000. And here 10,000. Further process cost given here 20, 5,000, 2,000. Now, the joint cost you have, you know how much? 1 lakh. How can we segregate this to these two products? Okay. In this case, whatever the amount you recover, okay, NRV. 1 lakh minus 20, 80,000 is the NRV. 75 minus 5, 70,000 NRV. 10,000 minus 2, 8,000 rupees. Now the joint cost 1 lakh will be segregated where 8,000 completely allocated to C. C is capable of managing product C here. So whatever the amount capable of adjusting that, you can adjust there itself. 10,000 is the sale value. Further process cost is 2,000 rupees. 8,000 rupees, they are now having capability to adjust the joint costs. From the 1 lakh rupees, 8,000 rupees is now adjusted for C. After that, balance is how much? 92,000. This 92,000 will be segregated in the ratio of 8:1. 8:7 between these two. Okay, maximum capable amount recoverable from C is now charged to C. Rest will be segregated to A and B in their own NRV ratio. I think 49,000, 67, and 42,933. In case of byproduct, you should not equally share that way. Whatever the amount capable of by that will be shared. What happens if the byproduct value is 0? Let's see. A, B, C. Sale value in this case being, sale price being, okay, units. 1,000, 500, 1,000. Sale price being 100, 150, 0. Sales value being 1 lakh, 75,000, 0. Further process cost 20, 5,000, 2,000. NRV being 80, 70, 0 minus 2, 2,000 rupees. What happens in case of C? We don't get even single penny, but we have to spend 2,000 rupees like a dust. So manufacturing process, after the manufacturing process, there may be huge dust may come. Okay. Disposal of that wastage will also be a cost. Okay. So we have to spend 2,000 rupees. No other way to dispose. We have to spend 2,000 rupees. We don't get in the revenue. So ultimately, our NRV for the C product being 0, negative. So now how can you distribute this 1 lakh? What the amount capable here? 2,000 negative capable. Leaving that balance being 1 lakh, 2,000 will be segregated to these two products in what ratio? 8:1. Actually, joint cost is 1 lakh, and loss due to the byproduct emerged here should be now shared by A and B in the ratio of 8:7. 8:7. Now the value being 54, 400, 47, 600. So the treatment in case of allocation of joint cost along with the byproduct is also completed. So in case of market value or value on realization, whatever it may be, is assumed to be the amount recovered. Or standard cost if we have, or comparative price or reuse price can be considered for the byproduct valuation purpose. Now, how can we treat the value for byproduct? Where can we adjust this? Where can we adjust this? Okay, in case of value of byproduct, that amount can be directly credited to the P&L account, one of the model. Another one is deductible from cost of production. Okay, byproduct is nothing but scrap value realized. What do you do in preparing cost sheet? Prime cost, factory overhead minus scrap value realized. That's how you will subtract. This is one assumption. Another assumption, if the value is very insignificant, credit to P&L account directly. These are the two options we have. If the value is considerable, then apportion like joint cost also be possible. A considerable value is there. If the product requires further process, NRV method is also be followed. So now we followed NRV method. So these are the options we have to adjust this overhead. One is adjustable in the cost of production. Another one is credit to the P&L account. Else, if it has considerable revenue, then it can be considered as a main product. If it is not so, NRV method can be followed. So these are the methods can be followed for byproduct. Now, accounting treatment for the byproduct here. Question number 9. In certain period, 500 units of main products are produced and 400 units are sold at 50 rupees per unit. The byproduct emerging from the main product is sold at rupees 1000. So amount recovered by selling the main product is byproduct is 1000. The total cost of production of 500 units being 15,000. Calculate the amount of gross profit under crediting the byproduct value to cost of production or cost of sales. Okay. Now find out the cost of production first of all. What's the cost of production? $15,000. This value of product byproduct will be adjusted here. Okay. Sale of byproduct. How much? 1,000. This is what about net cost of production. How many units are sold here? 400 units sold. So add opening stock of finished goods minus closing stock of finished goods. Cost sheet only. We don't have the opening stock of finished goods. But 400 units sold means 100 units may be closing stock of finished goods. What about the value of the closing stock? You can do the cross multiplication of this. 2,800. So 400 units, 11,200. 11,200 cost of goods sold. Add GP and you'll get the sale price. Sale price being 50 per unit, then you'll get 20,000 rupees, your GP being 8,800. So what happens, sir, if we are adjusting this in cost of sales, sir? Cost of production being 500 units at rupees 15,000, add opening stock of finished goods dash minus closing stock of finished goods. How many units? 100 units. 500 units produced at rupees 15,000 means for the 100 units, what could be the value? 3,000. So the value being cost of sales. 400 units, its cost of sales being 12,000. Now the value of sale value of byproduct is adjustable here. Where do you adjust is the matter. We can have multiple ways of handling the byproduct value. One is either crediting directly to the P&L account, or it may be adjusted to the cost of production, or it may be adjusted in the cost of sales. So here it is adjusted in the cost of sales model. So 400 units, the value being 11,000. With that, you add the net profit or GP, you will get the sale value. 400 units sold at rupees 450 rupees each. So the value being 20, your gross profit in this case being 9,000. These are the two methods we have. See, in a joint process, we get three products emerged. Sale value at this point being 1000, 2000, 500. Further process cost being 500, 400 and 200. Sale value being, after further process, sale value being 1200, 2200, 1000. Now come on, tell me, among the three product, which product can be processed further? Do we do further process or not is the question. In that case, how can you answer? Okay, what is the further revenue? This is sales value at split off point, after split off point, after further process. Okay, now what is the incremental revenue, sir? Incremental revenue, sales value after split off point, after further process minus sale value after split off point. 1000 rupees you can sell without further process. You can sell for 1200 at further process, after further process. 200 rupees extra revenue can be generated. But here also you can generate 200 rupees excess. Here you can generate 500 rupees. By additionally spending 500 rupees, you are earning only 200 rupees. Logically not advisable. Additionally spending 400 rupees, earning incremental sales being for 200 alone, logically not advisable. Additionally spending 200 rupees, but you get 500 rupees additionally, definitely you have to do. By processing further, C, you get 300 rupees additional revenue. In case of A and B, you are actually loser. Your revenue will decrease by how much? 300 rupees decreases, 200 rupees decreases. But in this case, increases by 300. So it is advisable to do further process for C. Product may be sold after split off point or further process. If further process cost is less than the incremental revenue, then further process is carried on, like C here. If further process cost is higher than the incremental revenue, further process is not carried on, like A and B. This will be A and B. Is that clear? So with that, all the theoretical concepts over. Let me solve one illustration asked in the exam, a comprehensive illustration, like, come on, you can join with me to solve this illustration. One of the comprehensive illustrations. Advanced problem in joint product. Let's see this first paragraph from here to here. Porkman Chocolates manufactures and distributes chocolate products. It purchases cocoa beans and processes them into two intermediate products. So from the cocoa bean, they produce two intermediate products: chocolate powder, liquor base. Chocolate powder, liquor base. Milk chocolate, liquor base. From common process. This will be cocoa bean. Input being cocoa bean. These two intermediate products become separately identifiable at a single split of point. Every 500 pounds of cocoa bean yield 20 gallons of chocolate powder liquor base and 30 gallons of milk chocolate liquor base. So 500 pounds for this much of input, you can produce to 10-20 gallons of chocolate powder liquor base and 30 gallons milk chocolate liquor base. The chocolate powder liquor base is further processed into chocolate powder. Every 20 gallons of chocolate powder liquor base yields 200 pounds of chocolate powder. So this can be further processed. Then you can produce chocolate powder. The output being 200 pounds. Milk chocolate liquor base is further processed into milk chocolate. Every 30 gallons of milk chocolate liquor base yields 340 pounds of milk chocolate. So this can also be further processed into milk chocolate. Around 340 pounds can be produced here. 340 pounds can be produced here. Clear? So this, what about the information given in the very first case? Production and sales data are given here. So this is the actual production and sales data. I may incorporate that here. Cocoa beans processed to 7,500 pounds. Actual process being 7,000 pounds. Almost 15 times greater than the earlier standard. For 500 pounds, this is the output given. Actual being 7,500 pounds. Okay, 15 times higher. The cost of processing cocoa beans to split up point being 7,12,500. Here, the joint cost being 7,12,500. And production, chocolate powder being 3,000 pounds. Almost 15 times higher. So into 15 times, right? So this is input is 15 times higher, then automatically all the output should be 15 times higher only. If it is 20 means 15 times higher, it should be 300 gallons. Okay, 300 gallons. This should be 20 times higher means 15 times higher means 450 gallons. This is 20 times higher means 5,100 gallons, pounds. So chocolate powder 3,000 pounds produced and sold. All the units produced sold, there is no output, no need to worry about it. And selling price being 190, and this is 237.5. This one is 5,100. 237.5. Clear? Now, this one. The October 2004 separable cost of processing chocolate powder liquor base into chocolate powder are this much. This one. Further process cost 3 lakhs 2,812.50. Further process cost. October 2004 separable cost of processing milk chocolate liquor base into milk chocolate being 6 lakhs 23,437.5. Cokepen processes both of its intermediate products into chocolate powder and milk chocolate. Currently, they are processing further and selling. This is the thing they follow. There is an active market for these intermediate products. The intermediate products, chocolate powder liquor base as well as milk chocolate liquor base are the intermediate product. There is an active market for that one also. Without further process, you can sell the liquor state itself, right? In October 2004, Cokepen could have sold the chocolate powder liquor base for this much. So this can be saleable at rupees 997.50 per gallon. 997.50 per gallon. And milk chocolate liquor base could have been sold at rupees 1,235 a gallon. Clear? So all the details recorded in a diagram manner so that we can easily solve the illustration without much hiccup. What is the requirement? 7,20,000 would be allocated between the chocolate powder and milk chocolate liquor base under the following methods. One is sales value at split off point. Another one is physical measures gallon, NRV method, and last one being constant GPR method. Come on. What is the sales value here at the split off point? Now find out the sales value here. Come on. Sales value complete 3,000 into 190. 5,70,000. This one being 12 lakhs 11,250. Total being 17 lakhs 81,250. And further process cost, total further process cost being 9 lakhs 26,250. Isn't it? Now what about here? This one being sales value at split off point. This one 300 gallons into 997.5 being 2 lakhs 99,250. 450 gallons into 1,235 being 5 lakhs 55,750. The total in this case being 8 lakhs 55,000. 8 lakhs 55,000. Now, sales value at split off point. Sales value at split off point. First case. These are the 4 methods. This is the working note. I'll keep it here. Come on. Sales value at split off point. Sales value at split off point. At split off point. For chocolate powder liquor base, 7,12,500 into split off point sales being 2,99,250 divided by 8,55,000. So I have to use this ratio. I have to use this ratio. 2 lakhs 49,375. Milk chocolate liquor base 7 lakhs 12,500 into 5 lakhs 55,750 divided by 8 lakhs 55,000. 4 lakhs 63,125. Is that okay? Physical measures. Second one being physical measure. Physical measure. For chocolate powder liquor base 7 lakhs 12,500 into gallons. No, total gallon being 300 plus 450, 750 gallons. 300 divided by 750. Come on, get me the value. 2 lakhs 85,000. Milk chocolate liquor base 7 lakhs 12,500 into 450 divided by 750. 4 lakhs 27,500. Next one is NRV basis. Yeah, find out the NRV. NRV is nothing but final sales price minus further process cost. Final sales is 570, further process cost is 3 lakhs 2,812.5. The NRV being 2 lakhs 67,187.5. Isn't it? So 12 lakhs 11,250 minus further process cost 6 lakhs 23,437.5. And this value being 5 lakhs 87,812.5. 812.5. What's the total value? 8 lakhs 55,000. You have to now segregate using this ratio. C. Chocolate. This is a NRV model. Under NRV model, CPLB is equal to 7 lakhs 12,500 into 2 lakhs 67,187.5 divided by 8 lakhs 55,000. Yes. 2 lakhs 22,656.25. Milk chocolate liquor base, in this case being 7 lakhs 12,500 into 5 lakhs 87,812.5 divided by 8 lakhs 55,000. So 4 lakhs 89,843.75. D, the point is all about joint constant GP and NRV model. Constant GP based NRV model. As already told, these are the specific model most of the times asked in the exams. So I have to calculate what? Constant GP. You have to calculate the GPR first of all. Now, you have to find out the GPR, sale value, total sales value. How much? 17 lakhs 81,250 minus further process cost 9 lakhs 26,250 and joint cost 7 lakhs 12,500. Subtract these two to get the GP 1 lakh 42,500. Find out the GPR 8%. GP by sales into 100. 1 lakh 42,500 divided by 17 lakhs 81,250. This is the GPR. As per GPR, constant GP method, okay. How do you calculate? Allocated joint cost is equal to sales minus GP minus further process cost. Okay. Now find out the GP here. Rather than working it, I just work out here itself. 8% on this. 45,600 GP. Here 8% on this being 96,900. Now allocated joint cost in this case being this one, sales minus GP minus further process cost. For chocolate powder liquor base, milk chocolate liquor base. Come on, tell me. Sales minus, for this sales minus 5,70,000 rupees minus 45,600 minus 3,02,812.5. What's the final value? 2,21,587.5. Similarly, if you calculate for the milk chocolate liquor base, 12,11,250 minus GP 96,900 minus further process cost 6,23,437.5. If you subtract, then this value being 4,90,000 rupees 912.5. We got this value. Now here, the fifth one I just guide you. You can try it yourself. It's very easy. Only calculation part is there. For this 8 marks, the last question carries 3 marks. Very interesting. But the second question carries only 2 marks, but it consumed at least 5 to 6 minutes to complete this work. You will not make the mistake, but it takes at least 5 to 6 minutes. What is the gross margin percentage of the chocolate powder and milk chocolate liquor base under each of the methods requirement in one? So under GPR, so how do you calculate the GPR? GPR is nothing but sales value minus further process cost, allocated further process cost and allocated joint cost. If you subtract these two from here, you'll get the GP and you can get the GPR here directly. Okay, for the first one, I'll just pick this one. Okay, so how much is that? Allocated joint cost being 2,49,375 and further process cost for this one being 3,02,812.5. Sales being 5,70,000 So sales minus further process cost minus allocated joint cost, you get the GP. I think the GP here being 17,812.5. For this GPR being 3.125 percentage. For what? Chocolate powder liquor base. Under what model? This one. Similarly, you have to calculate for the physical measures, estimated NRV method. Under constant GPR method is 8%. There is no doubt. For ABC, you have to calculate separate. ABC, you have to calculate separately. For this calculation, it carries only less than half mark, quarter mark only, right? So for all the four, 1, 2, 3, 4, 1 mark for chocolate powder liquor base. Similarly, you have to calculate for the milk chocolate liquor base, for that 1 mark, so 2 marks will be there. But the last question is very interesting. Could Pokpen have increased its operating income by change its decision to fully process both of its intermediate products? So now currently they are processing both the intermediate product into the finished goods. If they want to change this their decision, will there be any chances to increasing the profitability or not? That's a question. Very interesting question. In that case, what you have to do? You have to find out incremental revenue. You have to find out incremental revenue. Because of further process. You can sell for 2,99,250. Because of further process, you can sell it for 5,70,000. What is the additional profit or revenue you are getting? Because of further process, come on. Incremental revenue because of further process and increase in revenue. How much? 2,70,750. What about this one? 555,750 increased to 12 lakhs, 11,250. 55,500. Compare the first one. Further process cost. By incurring this much of cost, you are getting only this much revenue. So definitely you have to stop further processing this one. By incurring a matter of 6,23,000, you are able to increase your profit and additional revenue being 6,55,000. Definitely you can go for further processing this. So further processing can be done or not. Further process cost is less than this revenue, then you can do it. First case no, second case is. So currently the company for doing further process for both the material, but definitely it's not advisable to do further processing for the first material, CPLP. CPLP right now. If he stops this, what happens? 3,02,812 rupees 50 paise spent additionally for an additional revenue of 2,70,750. Now, spending to 3,02,000, getting only 2,07,000, then how much you are actually losing here? So from this, it is very clear your company's operating profit could be increased by 32,062.5 by changing your decision to further process both the products. You need to do further process only MCLB, not CPLB. Is that clear? For this decision, 3 marks. Think over for the calculation of GPR for all the model, it takes at least 3 to 4 minutes also. But for this, a matter of 1 minute, you can score 3 marks. Yeah, come on. Make a note of it. So with that, this topic is completely over. Joint product and byproduct is over. So we'll now deal with service costing, otherwise named as operating costing. It is a method of ascertaining cost of providing or operating a service like transport, hotel and hospital. You have to find out the cost for running the hotels and transports and hospitals and all. Preferably those costs can be classifiable into operating, maintenance and fixed or standing charges. Right. What are the costs may come under operating and running charges like petrol, diesel, lubricating oil and grease, etc. For the maintenance charges, it may be in semi-variable nature like cost of tires and tubes and repairs and maintenance. Fixed or standing charges like garage rent and insurance, road license, depreciation, manager salary will come here. Better you can classify that. That's all. Now let's start with first illustration here. To find out the kilometers car driven or bus driven, it's nothing but how many kilometers it is driven can be calculated. You convert that into the passenger kilometers. For example, from city A to B, the distance is 10 kilometers. If the car is driven from A to B, how many kilometers the car driven? The car driven being 10 kilometers. Okay, car kilometer. But car can accommodate 4 passengers. All the 4 passengers are traveling in that car. Now what happens? Every passenger covers 10 kilometers. Like for 4 passengers, 40 kilometers covered. That is called passenger kilometer. 10 kilometers into 4 passengers. 40 kilometers. Do you understand? This is called passenger kilometer. Though 4 passengers can travel, but only 2 passengers accommodated. Then what happens here? Okay, you can take what is the average. Average also be calculated. That's called average passenger kilometer and all these things. Instead of car, if it is being the lorry, how many kilometers the lorry is driven? 10 kilometers. What is the total load it carries? Sir, 10,000 kilograms, sir. Otherwise, 10 ton carried. 10 into 10 kilometers, so 110 kilometers travel. That's how you have to multiply with the tons also travel, or passengers travel, or kilograms travel. Let's see here. A truck starts with a load of 10 tons of goods from station P, and it unloads 4 tons at station Q and rest of the goods at station R. So P, Q and R. From P to Q, Q to R. While starting, it carries 10 tons. Here, 4 tons unloaded. Thereafter, it carries only 6 tons. It reaches back directly to station P after getting reloaded with 8 tons of goods at station R. Okay. So thereafter, from R to P directly it reaches, carrying 8 tons. The distances between P to Q and Q to R and R to P are, this is 40 kilometers. This is 60 kilometers. This is 80 kilometers. Compute the absolute 10 kilometers driven. In case of a number of kilometers driven, it's very simple. 10 plus 6 plus 8, 24 kilometers. Sorry, 40 plus 60 plus 80, 180 kilometers driven. But it is not only lorry driven, it carries goods also. The capacity of the lorry may be anything different, but actually they are carrying only 10 means you have to multiply with the 10. Actual will be taken. Actual will be taken. So 10 into 40, 400 10 kilometers. This is called 10 kilometers. And here 360, 10 kilometers. And this will be 640, 10 kilometers. Now what is the total? 1400 10 kilometers carried. This is called absolute 10 kilometers carried. Absolute. Absolute 10 kilometers. Now, this absolute 10 kilometers will not be the base for fixing the tariff. For the tariff fixation, commercial 10 kilometer will be taken. What is called commercial 10 kilometer? Actual average number of tons carried in the lorry will be the matter, not the actual one taken. Average will be taken. So, how many kilometers driven? 40 kilometers, 60 kilometers, and 80 kilometers. 40, 60, 80. What is the average load carried by this? Sometimes it may be 10, sometimes it may be 6, sometimes it may be 8. So divide this by 3. This is what about the average. Which is logically correct while fixing the tariff? This one or this one? Usually the second one. What happens if you go by bus? In the peak hour, the bus may be overloaded with 100 passengers. Early morning, maybe you have only 4 or 5 passengers. Will they charge the entire running cost of the bus for 4 passengers from the 4 passengers? Not possible. So only 4 passengers, so cost is higher. So you will not climb in that bus. So usually what happens, 100, sometimes 4, sometimes they will take the average of 50 or 52, and based on 52 only the tariff is fixed. That's why it is called commercial 10 kilometer. Commercial 10 kilometers based on the average commercial 10 kilometer. Clear? 1440. The ultimate answer be 1440. Clear? Now we'll go for the next illustration. Sankar has been promised to contract to run a tourist car on a 20-kilometer long route for the chief executive of the multinational firm. He buys a car costing 1,50,000. Annual cost of insurance and taxes are 4,500. So insurance and taxes are fixed charges. So insurance and taxes 4,500 and 900 respectively. I'll just sum up all the costs first of all, just similar to the machine hour rate. Okay, here rather than machine hour rate, it's cost per kilometer. That's all. So insurance cost 4,500 and taxes 900. He has to pay 500 per month for a garage where he keeps the car when it is not used. So per month 500. So garage rent, garage 500 into 12, 6,000 will be the garage rent, standing costs. The annual repair cost estimated at rupees 4,000. Actually, this will be maintenance charges. If you don't classify that as maintenance charges, you can post that in the fixed charges itself. So here, repair cost 4,000 per annum. The car is estimated to have a life of 10 years, at the end of which the scrap value is likely to be 50,000 rupees. Then what happens? You can calculate depreciation also. The car cost being 150, scrap value 50 at the end of life, the life being 10 years. So then 10,000 will be the depreciation. 10,000 will be the depreciation per year. He hires a driver who is paid 300 per month plus 10% of the takings as a commission. This is very, very important. So salary payable, driver salary being 300 per month, 3,600. Apart from that, 10% of taking. Taking means collections. On the collections, he will be given a commission of 10% also. You have to find out the final commission. On that 10% will be payable. Other incidental expenses are estimated at rupees 200 per month. Other costs, other expenses. 200 per month means 2,400. Petrol cost, petrol and oil cost rupees 100 per 100 kilometers. So now petrol. These are the variable expenses. These are fixed charges or standing charges. Now variable cost. Cost. Petrol. Petrol and oil. 100 per 100 kilometers, otherwise 1 rupee per kilometer. 1 rupee per kilometer. Right. The car will take 4 round trips. See, run a tourist car on 20-kilometer long route. See, from here to here, 20 kilometer. Go and come back. This is called 1 round kilometer. So 1 round kilometer is equal to 2 into 20. 20 kilometer for up and return another 20, so 40 kilometers. How many round trips they have made in a day? 4 round trips. Assuming that a profit of 15% on taking, so profit 15% taking should be there, and that the car will be on road for 25 days on an average per month. So this is what about a day for a month, for a year being into 12 months. Come on, tell me, what is the total number of kilometers? 48,000. 48,000 rupees. Per month being 4,000, right? Okay. Then petrol cost being 1 rupee per month. Otherwise, per annum, 1 rupee per kilometer for 48,000, it is 48,000 rupees. What is the total cost? You add up all this value. 79,400 is the total cost per annum. Total cost per annum. With that, you have to add what? Driver's commission. Driver's commission. Okay, how much is that? 10% of taking. Apart from that, expected profit being 20% of the takings. If you add up that, you will get the takings. Final fare. If the fare being 100, driver's remuneration or commission being 10 and profit should be 15, naturally the total cost should be 75. This 79,400 is nothing but total cost. The total cost is 75. Then what about the 10? You can do the cross multiplication. 10,000 87. Then profit being 15,880. Come on, add up this. 867. This is what about the total taking. Now, what is the question here? What is the question? What should he charge per? This is for 48,000 kilometers. Kilometers driven being 48,000. Now tell me, fare per kilometer. Fare per kilometer. 88.2. Okay, 88.2 for a round trip. 88.2 into 40 kilometers. Oh, then what is the, okay. What about the value here? This value? Fare per kilometer. Hmm? 2 point? Should be 2 only. 2 point? Correct. 2.20. You have to multiply this with 40 kilometers, right? Then it is 88.2. 88.2 will be the answer. Question number 3. Mahi Transport Company operates a luxury bus which runs between Delhi to Jaipur and back for 10 days in a month. So Delhi to Jaipur and back. 10 days a month. The distance from Delhi to Jaipur being 270 kilometers. Okay. 10 days, 270 kilometers, one way trip. For two trip, this is the distance travel. 5,400. The bus completes the trip from Delhi to Jaipur and comes back on the same day. The bus goes on Delhi Agra trip, then Delhi Agra trip. 10 days in a month. The distance from Delhi to Agra being 180 kilometers. This trip also completed on the same day. So on the same day, go and get back. So 2 times. Then the value being 3,600. Okay. For 4 days of its operation a month, it runs in the local city. Daily distance covered in the city being 65 kilometers. So local. 4 days. Per day it covers 65. Total 260 kilometers. This is what about the total number of kilometers driven by a bus per month. Okay. Kilometers driven per month. 9,260. And we have been given the cost of bus and depreciation, salary to driver and all. I'll now prepare the cost sheet here. Now tell me. Cost of bus depreciation given. So automatically you can calculate the depreciation first of all. All the details are per month basis. So it is better to calculate per month basis. Or you can calculate per year and then convert it back to per month also. No problem here. So depreciation. 15 lakhs into 15% into 1 month. Depreciation per month being 18,750. Salary of driver's salary. How much? 9,000 per month. Conductor's salary. 8,000 per month. Insurance per quarter given. Come on. If insurance per quarter per month is how much? I expected the same error. It's 3,600. A quarter consists of 3 months. Always you divide this by 4 and then mess up. Then diesel. Diesel is a variable cost. Okay, I can put here variable cost. Diesel. 49 per kilometer per liter. Distance covered per liter being 5. Means 49 divided by 5. How many kilometers driven? 9,260 we calculated. So 9,260 in the month. Come on, tell me the value. 90,748. Okay, 90,748. Token tax, like permit to stay your vehicle inside the bus stand and all, will be called as token tax. 8,100 per quarter. Per month it should be 2,700. Lubricant oil. Lubricant oil. 300 per 100 kilometers, otherwise 3 rupees. Number of kilometers driven 9,260. So the final value being 27,780. Further, we have these few more costs. Repairs and maintenance, 8,000 per month fixed rate given. So I consider this being a part of fixed cost. Repairs, 8,000 per month. Permit fee, 4,350, and the normal capacity being 50. How many seats are there in that bus? 50 seats are there. Okay, it means 5,400 kilometers driven with 50 passengers. That's what about the maximum or normal capacity seats available. And finally, this one. The bus generally occupied 90% of the capacity when it goes to Jaipur. In Jaipur, capacity percentage occupancy only 90%. In case of Agra, 80%. It is always full when it runs within the city, 100%. Passenger tax 25% of the fare, and calculate the rate the company should charge a passenger when it wants to earn a profit of 33 1/3% on its revenue. Profit expected being 33 1/3%. Is that clear? Now tell me, passenger kilometer driven. This is a kilometer driven by the vehicle bus. Number of passenger means you have to multiply with the passengers. So 5,400 and 50 seat capacity, but only 90% is full. Then what about the passenger kilometer? 2,43,000. Here 1,44,000. Here 13,000. Overall value being 4 lakhs passenger kilometers. Passenger kilometer. Now what about the total fixed cost and variable cost and total cost? This is fixed cost. You can get the total cost by adding all the three. This one is 58,900. Add up these two costs and get me the value. 1,77,428. Am I right? Total cost, variable and fixed cost, both as added here. 58,900. Are you getting this value or not? One item is missing. Part-time accountant. Is there anywhere given? Where? Accountant salary 4,500 is missing. Accountant salary. Our salary is missed. Okay. Now, so you have to add what? Passenger tax, and your profit. Then you will get the fare here. If the fare being 100, profit should be 33 1/3. Passenger tax should be 25. And it should be 41 2/3. Is that okay? You can do the reverse calculation. If the fare being 100, out of that passenger tax 25 rupees will go. 33 1/3 is the revenue expected. So naturally you can find out the passenger fare also. 1,77,428 into 25 divided by 41.67. Passenger tax should be 1,06,457. Profit being 1,77,428 into 33.33 divided by 41.67. 1,41,942. Your fare being 4,25,827. This is the fare. Now find out the cost per kilometer. Cost per passenger kilometer driven. 4,25,827 rupees divided by 4 lakhs. 1 rupee 0.65 is the cost per kilometer. Find out the tariff for traveling Delhi to Jaipur. How many kilometers are there? 270 kilometers per kilometer. It costs us 1.065 per passenger. 287.55 will be the bus fare can be fixed for a passenger. Delhi to Agra 180 kilometers. 180 kilometers per kilometer. We need to fix a fare being 1.065. 191.70. Local city, you no need to calculate that. Local city, anyway they may climb up and get down, so we are not able to finalize this. Hope you will be now able to understand the way how we can fix a bus fare and all. Clear? Question number 4. Global Transport Limited charges 90 per ton for its 6 tons truck lorry load from city A to city B. City A to city B. 6 ton is the capacity. The charges for the return journey are 84 per ton. For onward journey, 90 rupees per ton. For the return journey, 84 per ton. No concession or reduction in these rates is made for any delivery of goods at intermediate station C. In between there is an intermediate station C. Okay, so A, C, B. Clear? That's how it's going on. Six tons load carried. Here value being 90 rupees per ton. While returning, it is 84 rupees per ton. Though you can unload at station C intermediate, still the charge will be the same. In January 2020, the truck made 12 outward journey. Okay, 12 journeys were done. For city B with full load, out of which 2 tons were unloaded twice in the way of city C. What happens, you know, from A to B, 12 journeys, out of which 10 journeys with full load, and the 2 tons were unloaded twice in the way city C. Okay. For the 2 journey, for the 10 journey completely going on from where A to B. Ten journeys carrying 6 tons. And A to C, 2 journeys carrying 6 tons. C to B by the time 2 journeys carrying only 4 tons. Is that okay? 12 outward journeys for city B with full load, out of which 2 tons were unloaded twice in the way of city C. Okay, twice, 4 tons, 2 times. Rest of the times, fully loaded. Okay, here all the 12 times fully loaded. All the 12 times fully loaded. Clear? The truck carried a load of 8 tons in its journey for 5 times, but once caught by police and 1,200 was paid as fine. So while returning B to A, okay, 5 times with full heavy load, overload, 8 tons. How many times? 5 times. But once caught by police and 1,200 rupees paid as fine. So fine paid being 1,200. For the remaining trips, the truck carried full load, out of which all goods on load were unloaded once at city C. So B to A, another 6 times. Full load, 1 time. And thereafter C to A is empty. Thereafter C to A empty. Out of 12 times, 5 times with 8 tons load fully from A, C, B. And almost 6 times with a full load. This is overload, this is full load from A to C, C to B. Only once 6 tons A to C, thereafter unloaded. From C to B, it's what? Empty load, empty only. The distance from city A to city C and B are 140 and 130. So from this, it's very clear. This is 140 kilometer. This is 160 kilometer. Overall, 300 kilometer. A to C, 140, and A to B, 300. So C to B should be 160 kilometer. Annual fixed cost and maintenance charges being 60 and 12,000 respectively. Running charges were spent on January 2020 being 2,944. Now come on, tell me. What about the fixed charges, fixed cost? Fixed cost per month. We can calculate everything per month basis. Okay. So we are talking about January, so it's better to calculate per month basis. Fixed cost being 60 per month basis, it is 5,000 rupees. And 12,000 is for the maintenance. Then it is 1,000 per month. Running charges were spent during the period being 2,944. This is running cost. Total cost being 8,944. 8,944 will be the total cost. Is that clear? Now, so this is what about the cost. Apart from that, we have a fine rupees 1,200 penalty. Rupees 1,200. Okay. What is the requirement? You are required to find out the cost per absolute ton kilometer and the profit. And then the profit. So find out the absolute 10 kilometers first of all. Absolute 10 kilometers. A to B, how many kilometers? 300 kilometers, 6 ton carried. A to C, 140 kilometers. C to B, 160 kilometers. Hope it will be 18,000 10 kilometers. 10 kilometer. 1680, 1280, total being 20,960. This one, BTA 300, BTA 300, B to C 160. 12,000, 10,800, 960. Overall return journey being 23,760. Total absolute 10 kilometer 44,720. 44,720. Now find out the cost per absolute kilometer. Cost per absolute kilometer. Absolute 10 kilometers. 0.2. 0.2. Now you have to find out what is the revenue. Revenue. So from A to B, 12 trips carrying 6 tons, for every ton 90 rupees is the value. Yes, come on, find out the value. 6,480. Am I right? Now, while returning B to A, you have different part. B to A, B to A, 5 trips carrying 8 ton. B to A, 5 trips carrying 8 tons, and amount charged while returning being 84 rupees only. Okay. Another 6 plus 1, 7 trips carrying 6 ton. In between, if they unload, we never reduce the price. So it remains same. Here the price being, the value being 3360, 3528. So revenue being 12,168. Minus cost being 8,944. What about your net profit? 3,224. But you have to subtract the penalty. Penalty cannot be recovered. It is going to be debited to your P&L account. It's violation. 1,200. Ultimate revenue being 2024. This is debited to P&L account only. Costing P&L account. I think the total revenue is 13,368. Is it correct? Come on, cross verify this. 13,368. And after subtracting this one,
4,000.
net profit being
4,000.
okay, 4,424, and finally 3,224. Okay. So we'll move on to the next illustration. If it is clear, text me so that we'll move on to the next one. Now, a transport company has a fleet of 3 trucks of 10 tons capacity each plying in different directions for transport of customers' goods. 3 trucks and capacity being 10 tons. The truck run loaded with goods and return empty. While going, it will be fully loaded and return it is empty. The distance traveled, number of trips made, and the load carried per day by each truck are as entered. So this is what about the per day information. Okay. Analysis of maintenance of cost and total distance traveled during the last 2 years is as entered. Total distance travel and maintenance cost is given. This will be a hint for you to segregate this cost into fixed and variable. Okay, because two range traveled along with its cost is also given. So you have to find out what is that. Find out the variable cost as well as fixed cost for maintenance. Variable cost per kilometer being difference in cost divided by difference in kilometers driven. 46,050 minus 45,175. That's a difference in cost. Difference in kilometer being 1,60,200 minus 1,56,700. Is that okay? Now find out the cost per kilometer. 0.25. 0.25. Apart from that, you have to find out the fixed cost also. The total cost, this one being fixed cost plus variable cost per unit into kilometers driven. So 46,050 total cost is equal to fixed cost plus variable cost being 0.25 per kilometer into number of kilometers being 1,60,200. You can take the second year information also. By the time also you will get the fixed cost being the same. Here I have chosen the year 1. Now you can find out the fixed cost easily. 0.25 into 1,60,200 being 40,050. Am I right? And minus 46,000. This is minus, this is plus 46,050. Ultimately the value being 6,000. So from this it is very clear maintenance cost here being, so these are the other costs also be given. Okay, these are the other costs are given. In case of maintenance cost, 0.25 per kilometer and another 6,000 constant. Clear? The following are the details of expenses for the year under review. The vehicles operate for 24 days per month on an average. Prepare an annual cost statement covering the fleet of 3 vehicles. For all the 3 vehicles, you have to calculate the cost for a year, not per month. Thereafter, calculate cost per run kilometer. Okay. Determine the freight rate per ton kilometer to yield. So here we need to find out the kilometer. Here we have to calculate ton kilometer to yield a profit of 10% on the freight. So you have to calculate the freight so that it will give you a profit of 10%. These are the other informations. I'll pick this one here. Right. Now, truck 1 2, 3, one-way distance, kilometers, 16 kilometers, 40 kilometers and 30 kilometers. Number of trips per day, number of trips, 4 trips, 2 trips and 3 trips. Number of trips. Find out the total kilometers driven. 16 into 4, 64 into 2, 128. We assume this is to and fro. Okay. Trip means either it may only to or only fro. So automatically you have to multiply 2 trips. A round trip includes go and come back. 16 into 4 into 2. Whenever the term is round trip, it's nothing but going and getting back. Trip means only going, so coming back you have to yourself calculate and multiply. So 16 into 4 into 2, 128. So 40 into 2, 80 into 2, 160. And 30 into 3, 90 into 2, 180. And overall 468 kilometers driven. Okay. Okay, 468 kilometers driven. Per day. Per day. So you have to calculate per annum also. What about the kilometers per annum? You have to multiply with the 24 days in a month into 12 months. Into 12 months. Because we have to calculate the cost per annum, no? So you have to get all the information per annum basis. Okay. 24 into 12 months. 1,34,784. Now, load carried, tons carried per trip, 698. Find out the 10 kilometer. Be careful here. For 10 kilometer, while going, no, it's fully loaded. On returning, it's empty. Okay. So while calculating the 10 kilometer, 16 into 4 into 6 will be taken. On returning, it's 0 only, right? 16 into 4 into 6. Add on returning 16 into 4 into 0. So this becomes 0. So you have to multiply these two. You no need to consider the return trip. For the diesel and other things, we have to consider the return trip also. But while tariffing, this will not be considered. 384, 720, 720, overall 1824. Per annum, you have to multiply with 12 and 24, 5,23,000, 25,312. 312. Hope you'll be now able to understand this one. Clear? So we have to find total cost for the year. Maintenance cost 0.25 into number of kilometers driven, 1,34,784 will be taken. Okay, 1,34,784. Come on, tell me. And you have to add another 6,000. Fixed cost should also be addable. 39,696. Diesel. So this one is considered for diesel maintenance, all these costs. This one is considered for the tax tariff fixation. Diesel 10 liter, 10 rupees per liter. Each liter gives 4 kilometer. So 2 rupees 50 paise will be diesel cost per kilometer. So 2 rupees 50 paise into number of kilometers driven being 1,34,784 kilometers. Only this one will be taken. So the ultimate value being 3,36,960. Driver salary. 2,000 per month for 12 months, 24,000. But how many drivers will be there? 3 drivers. 72,000 will be there. Truck, you know. So 3 trucks are there. Definitely you are in need of 3 drivers. License and taxes. License and taxes. 5,000 per annum per truck. For 3 trucks, it's 15,000. Insurance. 5,000 per annum for all the 3 vehicles. Purchase price per truck. 3 lakhs, life being 10 years, scrap being 10,000. So 3 lakhs minus 10,000 divided by 10 years. Depreciation of the asset. Okay. 29,000 per truck into 3 truck. 87,000 rupees. 87,000 rupees. Oil and sundries. Oil and sundries. 25 per 100 kilometers, otherwise 0.25 per kilometer into 1,34,784 kilometers. This value being 33,696. Apart from that, we have general overheads. General overhead here being 11,084. So we have posted all the costs here. What are the requirements we need to incorporate? Okay, these are the 3 are the requirement. Prepare an annual cost statement covering the fleet of 3 vehicles. For the 3 vehicles, this is the annual cost. Total annual cost. Come on. How much is this? 6,436,000. Calculate cost per kilometer run. Okay. Cost per kilometer run. 6,436,000 divided by 1,34,784. Come on, get me the value. 4.45. Determine the freight rate per ton kilometer to yield a profit of 10%. So you have to make a profit also on freight. If you add the profit, then you'll get the freight value. If the freight value being 100, your expected profit on that being 10, so 90 will be the total cost. 6,436,000 will be the total cost. 90 share, then 10 share should be 66,715, and total value being 6,67,151. Now you have to find out the freight per passenger means per 10 kilometers. 6,67,151 divided by 10 kilometers being 5,25,312. So you have to divide this by this one. So 1.27 will be the price or freight per 10 kilometer. Cost for running the vehicle being 4.45 per kilometer. Clear?